Welcome to Lesson 1, Business and Ownership Allocation. Our objectives are to learn basic vocabulary of business organizations and then to compute financial responsibility of business ownership based on ratios and percentages. So how do businesses start? Think of everything you use on a daily basis, from things that are very complex and electronic to more simple things. Think about toothbrushes, straws, smartphones, remotes, paper clips, all those types of things. Who invented these? Who improved them? Where did the money come from to be able to develop these, to research and then develop, produce, and distribute those? Well, in order to raise money, you need capital. Capital is the money used to start or expand a business. And in order to do that, you need to have some sort of business. So let's look at the different type of businesses. Number one, you could have a sole proprietorship, and that's a business owned by one person. You could also form a partnership. This is a business that is owned by a group of people all called partners, and each partner will share in the profits and losses. Finally, the third main type of business that you could set up would be a corporation, and this is a business organization also owned by one or a group of people, but they're called shareholders, and each owner receives a share of stock. Let's look a little bit more detailed at what these different businesses do, some of the advantages and some of the disadvantages.
Main types of businesses exist in the marketplace: the sole proprietorship, the partnership, and the corporation. The two main concerns confronting the potential business owner when determining which form is best for them are taxes and personal liability.
The sole proprietorship is owned by a single person.
Hey there.
This makes it easy to form. The sole proprietorship is not considered a taxable entity on its own. The owner essentially is the company. In this form, no taxes are levied against the company itself, but instead, they are levied on the personal income taxes of the owner.
The partnership is when two or more people own a business without incorporating. Seymour and Chucky have just formed their own partnership to sell coiled plastic play toys to commuters. A partnership is easy to form and has a similar tax arrangement as the sole proprietorship because, just like the sole proprietorship, the partnership is not a separate taxable entity.
There are two main types of partnerships: general and limited. A general partnership is when each partner is involved in the day-to-day management and has unlimited liability for the debts incurred by the company. Limited partnerships, however, are a little different. In most limited partnerships, there is a limited partner who supplies the money and a general partner who supplies the expertise. Limited partners are liable only to their amount of investment in the partnership. However, their power in management of the company is also limited. In other words, in limited partnership arrangements, general partners run the show, just like you and your parents.
It must be said that these two formations have disadvantages in that, 1, it is tough to raise large amounts of funds or capital. 2, if the business fails, the sole proprietor and the general partner are personally liable for debts. And 3, it exists only if the owner does. If you die, the business entity dies with you.
Not only did he die, but so did the business entity.
The third type of business organization is called the corporation. The corporation as a form of business was created by a legislative act of the government as a separate legal body for the explicit purpose of conducting business. The owners of the corporation are the shareholders, or those who own stock in that corporation. How big your piece of ownership is depends on how many shares of stock you own. A corporation has most of the same responsibilities as an individual. It can sue and be sued, and is also taxed like an individual.
The advantages of the corporation are 1, no personal liability. The corporation itself can be sued, but not its individual investors. And 2, the ease of shifting ownership, which can be divided into stock and sold in public markets. And 3, the corporation lives on even after you don't. These factors all translate into an easier time for investors to raise capital.
We should have been a corporation! We should have been a corporation!
The major disadvantages of corporations are that they are more complicated to form and they are taxed separately by the government. This is known as the corporate income tax. The corporate income tax rate differs depending on the amount of corporate income and the whims of Congress. The corporate income tax basically results in a double taxation.
How's that? Because the business gets taxed and then the dividends or payments to owners of the company are taxed as income to individuals.
The same money is taxed twice.
Oh.
Let us walk you through an example of the double taxation that corporations unfortunately face.
Hey, my name is Dave Thompson, owner and operator of Tattoo U Incorporated, a national chain of tattoo parlors featuring excellent and courteous service, a sterile and clean environment, and the latest designs in tattoo formal wear.
For argument's sake, let's say that Tattoo U has been a big hit this year. It had a taxable income of $600,000. Let's also assume that the marginal corporate income tax rate for this year is 38%. Finance people call taxes marginal to kind of combine state and federal and everything else, so we do it too. So don't freak. 38% of Tattoo U's income is paid to Uncle Sam. Because the corporation is owned by many shareholders, those shareholders receive the financial return on their investment in the form of dividends. But this is where the double taxation comes in. Once those dividend payments are sent to the shareholders, they are taxed again by the government as personal income of the individual shareholders. So, first, the separate corporate legal entity of Tattoo U is taxed, and then its individual owners are taxed.
This compares to Our Heavenly Tattoo, a local tattoo parlor that is a sole proprietorship run and owned by Big Jimbo Floyd. Big Jimbo's income from Our Heavenly Tattoo is considered his personal income because his business is a sole proprietorship. So, the income from the business is added to Big Jimbo's income without a separate tax to Our Heavenly Tattoo. Jimbo is taxed at his individual income tax rate. He's only taxed once.
It must be said that although corporations do have disadvantages, most companies incorporate, unless they're very small. Why? Because it's easier to raise capital or funding for your business as a corporation. Raising capital as a sole proprietor or partnership is much more difficult. Also, investors in corporations have limited liability, meaning the most that they could lose is the amount they invested in the company's stock.
Well, now you should understand some differences between corporations, partnerships, and sole proprietorships. Understand that there are some other forms as well, but they are similar and resemble the C corporation, the partnership, or the sole proprietorship. Now, let's go ahead and look at some math. Let's look into ownership percentages. When you own a business, you don't necessarily own 100% of the business, as in a partnership or a corporation. So, when you own a business, we need to sometimes know what percent of the business that you own. Ratios and percents can be used to represent the financial responsibility of owners and partners. Remember, to convert a decimal to a percent, you just multiply by 100. If you're going the other way and you're converting a percent to a decimal, then you divide by 100. When you're working with math problems, you always want to use percents in the decimal form. So if you have a percent, make sure that you divide by 100. Let's look at the first example. Michelle invests $15,000 in a partnership that has 4 other partners. The total investment of all partners is $240,000. We need to know what percent of the business that Michelle owns. And this is important because at the end of the year, she will get a statement showing her percentage of all the income and losses and gains of the business. So we need to calculate what her percent is. How can we do that? One way to figure this out is to set up a ratio and to know that a percent is equal to a part out of a whole. Well, she owns $15,000. That is her part. And the whole represents what everybody has put into it or what the partnership is currently worth. which is $240,000. So if we can divide 15,000 by 240, we'll be pretty close to figuring out what percent she owns of this business. Now we get 0.0625, but we're working with math, so that's not the percent yet. That's the decimal form of the percent. In order to figure out what percent that is, we need to multiply by 100, or move the decimal 2 spaces to the right. She owns 6.25% of this business. So at the end of the year, she would be allocated 6.25% of the income, the losses, everything. Example 2. The total number of shares of stock in the Bulls Corporation is 650,000. So that's the number of shares of stock. Mike owns 12% of these shares. So how many shares does he actually own? And this will be important because corporations pay dividends, as you learned in the video. And they pay dividends based on the number of shares. So if a company said that they were going to pay $1 for each share, we would want to know how much is Mike going to receive. So how can we figure out what 12% of 650,000 is? Remember that a percent is a part out of a whole. 12% is 12 out of 100. Percent means out of 100. So we can set up a proportion, two ratios that are equal to each other. We want to know what percent or what part out of the total, which is 650,000, that Mike owns. If we set up a ratio on each side and we have equivalent fractions here, we can just cross multiply in order to figure out our answer. So in other words, we'll take x, multiply it by 100. That will get us 100x, and then we'll set that equal, because here's our equal sign, to 12 times 650,000. That's a big number. That comes to 7,800,000. But we need to solve our equation now, so we need to divide both sides by 100 in order to solve for x. If we do that, we can cross out a 0 here and a 0 here, along with 2 zeros on the top. So now we know that Mike has 78,000 shares. This helps us then when the company makes a dividend declaration, like we said. So if the company said we are going to pay $1 per share, Mike would get $78,000. He can use that to help him when he estimates his taxes, for example. Example 3. 3 partners are investing a total of $900,000 to open a garden and landscaping store. Their investments are in this ratio, 2, 3, 5. How much does the partner that invested the least contribute? This is a little tricky. Think about it for a second, pause the tape, and then come back to see if you have set it up correctly. Remember, we're dealing with ratios. When we're dealing with ratios, we can take parts and compare it to the whole. We want to know how much the partner that invested the least contributed. Well, we have a partner that invested 2 compared to a partner that invested 3 and 5. You can think of these as dollars if you'd like. How many dollars did they invest in total if this is the dollars that they invested? Now these aren't the dollars, this is just the ratio. For example, if you invested 20 and I invested 10, then our ratio would be 2 to 1. But that doesn't mean that you invested 2 or I invested 2 and the other person invested 1. That's just the ratio. So that's what this represents. But let's go ahead and set up our part to whole. The partner that invested the least invested 2. And the total, if we add these together, 5 plus 3 plus 2 is 10. So here is one ratio, which sometimes if we look at it and we can reduce it and simplify, we should do that because then it'll make the math easier. 2 goes into itself once and it goes into 10 5 times. Okay, so we have a part to a whole. And we want to know how many dollars out of the $900,000 was invested by this partner who only invested 2 out of these ratios. So once again, we have a proportion that we can just cross multiply to solve. X times 5 is 5x, and 1 times 900,000 is just 900,000. Now we're ready to divide to solve for x, so we can divide by 5. And that means we get a dollar amount of $180,000. So now we know how much the partner that invested the least contributed out of that $900,000. That can also help us if we want to figure out what percent that partner put in. We could also figure out what dollar amount the partner that contributed the most put into it. Because instead of doing 2 over 10, we could have done 5 over 10, which reduces to 1/2, and then we could have compared it to x over 900,000 again. We could have done the same thing for the partner that contributed the middle amount. So this is just one way to solve problems of ownership allocation. That concludes our lesson, but now at the end of this lesson, you should understand some basic vocabulary of business organizations. You should also be able to compute financial responsibility of business ownership using ratios and percents.